If this is your first session or the first time attending one of these webinars, you will be happy to know that we don't spend time talking about ourselves or selling you something. So we know that you are busy people, and taking this time at lunchtime is already a big ask. So we launched this collaboration series in 2023. This is by business owners for business owners, with the objective of addressing specific business challenges that we have seen with our clients. And the idea is to bring experts to share their knowledge, but with a focus on delivering tips that you could put on practice. So basically that you can take something today at lunchtime to start implementing in your business. So the topic of today is the cost of ignoring your numbers. So BBCS will be soon 4 years. And one of the topics that continuously arise with the many business owners that we work with is struggling with the finance, understanding how to keep it under control, or sometimes even the relationship that they have with their accountants. When we ask things like, do you have a budget, cash flow forecast, how do you manage your expenses? They might answer something like, oh, my accountant knows. Or if they have some problem with the accountant, they will tell me, well, my accountant doesn't really help. So our guest today is Angela O'Leary. She's the founder and the MD of AG Associates in Little Island in Cork. And they offer a wide range of accounting services to take the stress out of managing your business finance. So welcome, Angela, and thank you very much for joining us today.
Hi, Susanna. Absolutely delighted to be here. Thank you so much for the invite.
Oh, you're very welcome. So, but normally I start with my guests asking them, share a little bit about how you started your journey and your company.
Well, I founded AG Associates Accountants over 18 years ago, Susanna, and a real main reason was I could see a lot of business owners didn't understand their finances, and they didn't have that visibility, and I wanted to change that. So we provide a full range of services from bookkeeping, management accounts, year-end accounts, payroll, taxation, and cloud accounting, and training and bookkeeping and payroll as well. So we really are focused on trying to get business owners to understand their finances so that they can steer their business properly.
That's brilliant. So one of the things that really caught my attention from the beginning when I met you, and then reading your website and obviously following in social media, is that the language that we use, it is all written in words that everybody can understand. So how did you manage to get rid of the jargon and use plain language?
Delighted to hear that, Susanna. Thank you. Well, I find business owners, they wear so many different hats. They're, operations manager, they're managing their marketing, HR. The list is endless. There is constantly something to do. And what I have found from experience is they often tend to shy away from their finances. They don't really understand them. They kind of tend to put them to the back burner. So what I would say there is that can be one of the most expensive mistakes that a business owner can make. And it's really key that they understand their finances, even at a very basic level, and have those key performance indicators. It's so important in order that they can drive their business forward.
That's good. So just for the people on the call, you can ask your questions. You can put it in the chat or in the Q&A area. We will answer as many as we can. And we are going to dive into this. So some of the key challenges that business owners face when it comes to finances. And I would like to start with the financial blind spot. So Angela, what are some of the biggest money mistakes business owners make without even realizing it?
Okay, so first and foremost, I would say not knowing their numbers. So failing to regularly review their financial accounts, what's their profit, what's their gross margin. I would say poor cash flow management would be another. Your cash flow is the lifeblood of your business. You really need to be aware of your money's in and out. Another would be underpricing their products or services. I mean, that's going to erode their profit margin. Others would be, say, uncontrolled expenses, hidden costs. The business owner isn't tracking their costs effectively. And as a result, then they may have issues failing to pay suppliers on time, issues with tax liabilities that they're not able to pay their taxes. And this is all surprises. So I would say for the business owner, they need to have those points in place on your cash flow, on your net profit and your sales revenue and that. Yeah.
Okay, so because talking about the blind spot, I'm trying to, there are a lot of numbers in what you mentioned now, but tell me, which are the key numbers, or we normally will call it key performance indicators, so KPI, but the key numbers that should a business owner check regularly, and if you can give me the frequency, so for example, monthly or weekly, monthly, quarterly, so that
Yeah,
a
great
couple of
question,
numbers that we
Anna.
should.
Yeah, so revenue to start with, that's really key. I would recommend that you have sales target sheets for that and that you review that on a daily, weekly, monthly, and annual basis, and even do that comparatively as well. So you can check what was the sales performance relative to the same period the last year. Was there any seasonal impact, weather impact, various different reasons, whether your sales were increased or reduced. Your profit margin is another. So know your gross margin. So that's your sales lost, your cost of sales. So, are you meeting your margin? If you're not, why delve into it? Then your net profit would be another. So making sure that you have the profit targets that you want. A really key area here is your break-even point. So this is the point of the revenue that you need to make that's going to cover all your costs. I know a client of ours, they're in retail and say they know by every Thursday that they've broke even. And then anything after that is profit. So it's whatever way works best for the business owner, but just for them to understand what is that and what's profits after that. Other areas would be employee productivity metrics. How productive are your team? Is there any inefficiencies there that can be looked at and things that are improved? Tax liabilities is another, just ensuring that all your taxes are paid on time. Again, with clients of ours, they sometimes have a buffer account, a buffer bank account. So they transfer in, say, funds to offset against their VAT and their PAYE on a regular basis. So they
Okay, so
ensure that they're
sorry, when
paying.
you say, sorry to interrupt, when you say tax liability, you mean knowing the number that, for example, if I sell something and I have to pay the VAT, I know that if someone paid me 100, I know that I have to reduce 23% of that money is not mine. So you can either separate it from your account or just know that if my account's at 100, I know that 23% of it is not mine. And then is that what you mean?
Yes, that's exactly it, Susanna. And it's knowing, it's either knowing and having that available, or else for some business owners, it actually helps just to move it to that other account. So it's there on the ready when their tax is due. And I suppose a key area would be your accounts receivable. So it's essential to invoice on time and also to be paid on time. And I recall a client of ours, they had mounted about 100K in debt. So they had invoiced clients late and they weren't being paid on time. And it was preventing them from paying their suppliers. It was a complete bottleneck in their business. They were having big cash flow problems. So you really need to make sure, I know it's not pleasant chasing your customers for money, but it has to be done, that you have all those checks in place.
Okay, just to summarize, so we talk about revenue with having sales targets that you can track either daily, weekly, monthly, annually, and better is in comparison and knowing seasonality. Two, profit margin, that it is gross, that it is basically the sales minus all the cost of goods or cost of doing the sales. Number three is net profit. and understanding your break-even point. So if you know what is your break-even point, you know when you stop working for paying and you stop continue working for making money, put in your pocket. And the 1, 2, 3, 4, tax liability. So understanding how much money and where the money is to pay the taxes, and employee productivity, and account receivables. That basically account receivables, the people that you need to invoice that they need to pay you for that invoice. That the summary?
Exactly. That's excellent.
Okay. So a lot of business owners will say things like, as long as the sales are good, everything is fine. So tell me, why focusing only on sales or revenue is a mistake?
Okay, so I would say, as that saying goes, sales is for vanity, but definitely profit is for sanity. So just to stress, your sales don't equal your profits, and you may be generating more sales, but your costs may be rising at a faster rate, and then you're in trouble. You're not making a profit. And I would also say cash flow is king. So to be aware that if your sales are rising, your costs rising, is the money coming in? Do you have sufficient cash in? Is there enough to cover your monies out and your various expenses? And that also includes the hidden costs of expenses. So you really need to focus and track all of your expenses. Um, Regularly check through them. And also, I would say burnout and quality issues. That's another, if you expand too quickly, you can encounter issues like that as well. And it's really paramount to look at the big picture, your sales, your cost of sales, and your cash flow, and that it's all running seamlessly together. And yeah, so I would say, that's really an unbalanced approach. While it's great to make the sales, you really need to maintain all your costs as well and your cash flow. And it's all part of strategic planning. If you're focused just on one area of your business, you're not going to really get the real picture, both short term and long term, of how your business is actually doing.
Yeah, that's a very good advice. So actually, we focus on profitable growth, we call it, or sustainable growth, because it's not about generating a lot of sales. You cannot continue delivering the service and the quality that your customers know you for. And also, if you're not making more money. If you're not making enough money, actually, it doesn't make any sense to have more invoices to deal more customers if you're actually not making money.
Yeah,
So
that's
going back to the point of the cash flow. So how can cash flow problems put a business at risk, even if they are making sales? So you touched on it slightly in the previous question.
Yes, exactly. So cash flow, it's the lifeblood of your business. If you don't have sufficient cash flow, you're going to struggle to pay your bills. You don't want that issue that you're delaying your payroll. You need to keep the morale up, make sure that your team and your employees are happy. Another would be that if you don't have that cash flow, there's issues potentially that you may damage key supplier relationships. Ensuring that you pay your suppliers on time, that you keep up that relationship with them, and also say an inability to handle emergencies. There often are those unexpected costs that come up in everyday business, that they're unavoidable, and that you have that buffer in place. So it's ensuring that all the cash is coming in, and that it as it's going out. And I would always say as well to our clients to have a cash flow statement. There's very easy templates. We often go through them with our clients, and it's just a basic what you expect your cash to be every week and month. And you can actually forecast that up for even 9, 10 months ahead, especially even in seasonal business. So, if there are dips, you can be aware of those, maybe take out some sort of funding to cover that. And then, you're in the black again, and, everything is much better in the busier time, so that you've just accounted for all of it. Yeah.
So that's a cash flow. It is a very critical point, and I will go into more details questions to come back to that. But first, I want to, obviously, you have been working with hundreds and hundreds of businesses over the years. Which are, this is because when you have the experience, we know that we can see things before they happen. And it is, I always feel like a very old person because it's like, oh, I just see that where that is going. And I feel like my mom when I was a kid, that she knows. But the reality is in our areas of expertise, we can see warning signs of things that they are going to happen later. So which warning signs a business owner should be looking at in their finances before problems get very serious?
Okay, so first and foremost, I would be quite concerned if your bank balance is quite low and if it's consistently low. And again, to have those checks, are you being paid by your customers in time? What are your debtor days? Do you need to chase up more with that? Also, are you struggling paying your suppliers? Why is that the case? Again, checking your cash flow on that. Again, with your tax liabilities, again, is there an issue there? Have you been able to have a buffer in place, for instance, as well for, like unexpected costs? But what I would say as well is like key areas there would be like your declining profit margins. If you find that your margins are falling, you mightn't have a price as a cost price. It could actually be basically lower than what you have expected or higher, and you need to set your selling price correctly. And I suppose the key thing there is just not keeping proper books and records. That's what the whole thing is about. Before you do anything else, you need to have proper books and records in place. Have a good account system so that you know well in advance what the warning signs are, and you can act accordingly. If you have those in place, you're going to see those warning signs from the get-go, and then you can react more quickly. But if you're in the dark and there's a delay in time then, and it can be a lot more serious an issue. If you're not fully aware of what's happening.
So when you say books and records, you mean that you are really tracking all your expenses, all your incomes, and religiously knowing that it's accurate and also reviewing it. That is what you
Yes,
say.
exactly. It's bookkeeping. And I think a lot of businesses, they tend to underestimate that as well. Like your bookkeeping is pretty much the cornerstone of your business. It's so important. And if you maintain it well, it will pay you dividends in the short and long term.
Yeah, so actually I was talking to someone yesterday, and obviously with all the conversations that we had, I had with you, I was just saying it's like, look, having good done, if you have a very good keeping, it's very difficult to file wrong accounts. It's very difficult that you will make a lot of mistakes afterwards. So bookkeeping, it should be, if you do it right, it's very difficult to make mistake afterwards. So,
yes, absolutely. And there's so much visibility if you do the bookkeeping right. And there's some great software systems on the market as well. Some of the cloud accounting systems like Xero, for example, are excellent. And what they can do is you can set up bank feeds. You can have your invoices sent in automation, statements sent out. It integrates all of your bookkeeping. So then it's very easy to do management accounts from that as well. So it's really enabling you to keep a very good tight control of how your business is operating.
yes, and also reduce a lot of manual and repetitive work that it helps for productivity and for actually being able to scale the business. So,
Yes.
okay, let's talk about profits. So many business owners would say things like, my business bring more money, but I still don't have money in my pocket at the end of the day. So what's happening?
Well, it's great that you're say your business is bringing in more money, but again, how much money is going out, and usually in this particular case, if if there's a lot more sales coming in and you're not making a profit, there's rising costs. So it's really just being fully aware of that. Are your costs rising disproportionately to your sales? If so, by how much? Um, Another reason would be uncontrolled spending, or you think your business is going really well, so you're getting excited, you're going on these spending sprees, like put those budgets in place to make sure that you're not overspending and that you have your cash flow there and your buffers there. Other reasons would be, say, low profit margins. So your sales are great, but you have discounts, or you're not charging enough for your services or your products. And if that's the case, it's eroding your profits, and again, it's you're basically potentially losing out in the long run, depending on that. So you just to be very clear, you need to make sure that your selling price is good, and poor cash flow management. That would be another thing. So just making sure that you have your monies coming in and out. I know I keep mentioning that because it's so essential to your business, that you can cover all of your immediate costs. Also that you can cover your taxes. Again, just making sure, say, if you underestimated your taxes because your sales are growing, your taxes, your liability is also going to grow. So your VAT, for instance. So just to be aware that you need to put more aside for that. And I would think, if you're asking those questions, there's a lack of financial visibility there. So again, I would just delve into the figures and see, where are you losing track? What's happening? What's going wrong? That the profits aren't growing. Again, it can be an inventory issue as well. Say poor stock control. It's really key to ideally have your bare minimum stock, or that you're making sure it's all moving, and that you don't have large volumes of stock there that may become obsolete, and then you may not be able to sell it at all. So
Yeah, I do. I have two questions about pricing. So, because what you're saying, obviously, it is, and I've seen so many times that people, for example, is in pricing that they will just price everything with the same margin. They don't think about that the pricing strategy can vary depending on type of product or services, and and it is not, you don't have one for the whole company for everything. So it's vary. So tell me, so the first question, and because I do a lot of marketing, and I always shy away from discounts. Price discounts, I don't like price discounts at all. I don't suggest it, and I try not to implement it. So tell me your opinion on how do discounts hurt profits, and especially if they are not bringing the extra sales. So that is the explanation of how much sales you need to bring, because that is a part that people don't really understand when you actually do it. So, sorry. So tell me how the price discounts it hurt the profit.
yes, so I suppose firstly, if you're making small pricing mistakes, if you're selling large quantities, that's going to make a much bigger impact on your business. So I would always say, regularly go through your pricing and assess it, see the trends, see, be it product or service, are you charging enough? What's it costing? Do your break even point on it, as I was saying earlier. And then in relation to the discounts, you're absolutely right. I think if you ever apply discounts, it should always be a targeted discounts, maybe on sale items, or very particularly good reasons for giving your discounts. And I think the calculation of the discount should be prepared in advance so that you can see exactly how much that's impacting your gross margin. Because as we were going back to before, if you're getting lots of sales in and it's all highly discounted, it's not really going to benefit you if your gross margin is going significantly down. But if you are providing discounts, I would, definitely ensure that you're, selling a much larger volume to maintain your margin. And as we were saying, know the figures there. But the other side effect on that is you're actually, if you're providing a lot of discounts, you're almost training your customers to expect lower prices, and ultimately it can devalue your brand. So, it's almost like your customers are waiting. Okay, I'm not going to buy now. I'm going to wait until the discount again. And, that again is eroding your profit margin. So there's also hidden costs and discounts. Say, you have to do extra marketing, pricing, advertising, printing, etc. for that. And there's an impact on loyal customers there because your loyal customers are accustomed to your regular prices. So again, they may not, feel value that, okay, they're paying this, and then there's lots of other discounts. So it is something to be very wary of. And I think in the market as well, you know, there's your competitors could follow suit. So there's no one gaining then at that point, because the margin is being eroded, and you're not really charging what you need to charge for your product or service.
Yeah, and so that's very useful. And because also one thing that we also see a lot is basically if you lose a customer on price, or you win a customer on price, so someone buy for you because you are the cheapest at that time, you will lose the same customer on price again when someone else, because someone else at some point will become cheaper than you. So unless that you really prove the value that customer have of working with you, that you're really proving how you're solving someone's problems, and really working on the risk of not working with you. So this is not, it's just what happens if I stop working with you. I will so if the value is there, they will see that the working with you is more than paying for one thing. It is the whole sort of peace of mind and benefit that I have for being with this, receiving this service or buying from this person. And I think that is, we buy value. We don't, if there is no way to differentiate the value, we will buy on price. So I always make the example of going to buy a washing machine to Harvey Norman or a printer. And you arrive and there are all the different products, all with a little label this size in the corner that you can read the different descriptions. And the only difference are brands. And then you will say, okay, I had a good experience with my HP brand printer, so I will buy again the HP. Or I had a bad experience with the HP printer, so I will not buy that one. I will buy another one. And if I don't have any brand recognition, I will probably go for the middle because it's not as bad as the cheapest, but it's not as expensive. Basically, if you don't really communicate value and you go for the direction of pricing, it's very, very difficult that your customer will get loyal. So basically, you are turning customers all the time.
So
So
true.
we have a question,
Yes.
and I will just to break it in here. So what does it mean to do bookkeeping right?
That's a great question. So to do your bookkeeping right, I would just make sure that you basically you put in all of your sales invoices and maintain your sales correctly, and then for your purchases and your suppliers and overheads, that they're all processed correctly as well. And your bank is reconciled. So it's all part of reconciliations as well. And as I was saying before, if you have a good account system and some of the cloud accounting is excellent, you can really this particular software can make this process very, very easy to do. So it's having all your checks and balances in place, that your supplier invoices are being reconciled, that you're receiving all your credits, that your bank is fully reconciled, that there is no incomplete or missing records in your bookkeeping, that it's fully integrated. So that's what's keeping good bookkeeping. Yeah.
That's good. So tell me, what does it mean, reconciled? So the term reconciled for
Okay.
someone who is not in the finance world, how you would explain that?
Yeah, so reconciled really means that it's matching what it should be matching. So for example, if I'm doing a bank reconciliation, I have my bank account and then I have my transactions that are in place in my accounting software, and I'm matching them against each other
Mhm.
to ensure that they balance. And obviously, if there's any issues in anything, it needs to be queried along the way. Say if, for instance, you were waiting on a refund from a supplier and you hadn't received it, you're going to check your bank and you're going to check your supplier activity, and then you're wondering where is the credit, and then you see it's not coming through your bank or it's not being issued as a credit note. So you're following that up to ensure that you receive the credit that you're due. So that's just an example of that. Yeah.
Okay, yeah, that's perfect. So before we continue, I have another question. So I'm currently a sole trader, but I'm confused as at what point I should consider moving to a limited company.
Yes, I mean, there's pros and cons with both. That's a great question. It depends on a lot of areas. I mean, it depends on the turnover. It depends. I mean, with limited liability, there's the advantage there as well. You're incorporating, if you have an exit strategy with your business as well, it's definitely better to go limited, and with the various tax reliefs along the way with that too. So what I would usually do with the client, I would have a consultation with them and do a comparison between both. I suppose with a limited company, it's very much an entity in its own right. So if you're a director, you can't take director's loans. Really, that's frowned upon. It's in breach. And what I would say is it's all very much the company is its own entity. You are, as a director, receiving your wages, etc., etc. There are returns that need to be filed to the CRO. But with the sole trade, there is a little bit more flexibility that the business owner can take drawings. It's usually less expensive to maintain financial statements. With the sole trade, you don't have requirements to submit accounts to the CRO. But in terms of from a tax efficient approach, there is a certain cap when it is best to go limited. And I would really do that on a consultation basis and advise on that.
So as a follow-up question is this, what is the turnover level that when reached would suggest a discussion with my accountant? Because obviously if you are actually at the first year and you are and you're, I don't know, doing 20,000, you probably will not be having the conversation anyway. So what is this? Is there turnover level that when they
Yeah,
could think
again,
about?
I suppose it depends more on profit and the circumstances, but I would definitely recommend, as your business is growing, even at the 100K mark, I really would be looking to go limited at that point. I mean, there is a lot of advantages with it, even in terms of exit strategies, as I was saying earlier. And also there's corporation tax, which is it's very low in Ireland, 12.5%. And then you can control what wages you're paying yourself through the business. So, for instance, you could keep yourself at the 20% mark initially, and then bring yourself up to the higher 40% income tax bracket, depending. And I suppose there's just there's more grants that you can avail of as well when you're limited. So there can definitely be some tax advantages to it.
Oh, so continue with my question. So what happens when business owners don't plan their finance properly? And also, if you can give an example of what it looks like not being planned properly.
Okay, so I suppose if it's not if your business is not, finances aren't being planned properly, you're effectively working in the dark, that you don't have that visibility. So there could be a cash flow crisis because you don't know what the next bill is due, if there's unexpected costs there because you're not tracking your expenditure properly. Also, you could have missed growth opportunities because you don't have sufficient cash flow in place. You won't be able to, go ahead with a growth opportunity, maybe like expanding your team or scaling operations because you don't have that visibility in your accounts. Again, issues like not paying your taxes on time, not having the ability to do that, over or underspending. So if you don't have a budget in place, you have very little or no control over your expenditure, looking and saying, okay, that's really high, we need to bring that down, it's gone over budget, what can we do next month or in the next 2 months to bring that back in line? I would say inaccurate pricing as well. Poor financial planning means you don't fully understand your costs, and that can lead to under and overpricing of products. I would say unclear financial goals as well. Again, if you don't have visibility on your accounts, you can't plan your business in the short term and the long term. So what's really a good practice with business owners, when they have good bookkeeping in place and they're maintaining their management accounts, they can make projections. So they can say, okay, well, next year I want to increase my sales by say 5%, and I want to reduce my costs by say another 5%, and they have budgets in place which they assess and look at regularly. So if you're not planning your finances, you can't really have any control over that. And I suppose, like as an example, there is one particular client of ours in retail. They're very, very focused on planning their finances, and they have their month end done within like the second week of the following month. They know their cash flow. They know what their break even point is. If their sales are down, they can ask the questions why. And it means now that they're expanding, and they're basically opening another retail unit, and that's because they have such a good control over their finances. So it's for the short term and the long term.
Well, that's a very good answer. And so for those people in the call, so with Angela, we offer complementary services to businesses. That means that we can work alongside a business owner at the same time, because Angela focuses more in the numbers. And for example, if a business owner wants to grow 25%, so she will look at all the areas, if it's achievable, how much money do we need to keep, so on and so forth, forecasting, so on. And what we focus, it is how are we going to achieve that? What are we going to sell to whom? And how we can improve operations so that we are selling more, but we are selling, spending less or with less cost. So that's how you could see these plans coming together to achieve what the business owners want to achieve, whatever the goals they are. So I have two questions. One, because the question actually include a word that I want you to answer first. So what does it mean, management accounts?
Okay, so management accounts, it means accounts that you are preparing for the management team in within the company, usually it's a monthly or a quarterly basis. So it's not your year-end statutory accounts that are being, say, filed with the CRO. It's basically your management accounts, which would be your profit and loss typically, and your balance sheet, and often a cash flow as well. And they can be maintained on a monthly or a quarterly basis. And what it means then is you're looking at the performance of how your company operated over this period. So for instance, you have your own profit and loss, so you can see, say, for the month of February, this was the sales that came in. These were the cost of sales. So the sales less cost of sales is my gross margin. And then these are all my overheads. So my wages cost this, the rent is this, and so on and so on. And then you can see what your bottom line is. Where are your profits? So that's effectively what it is. And I couldn't recommend it highly enough, really, to steer your business.
Yeah, so basically the management account, it is information that you will have at ready to be able to make decisions within the year that you are working on. So you will see what's happening and you can make decisions for the next, whatever the period that you're looking, a quarter, a month. While the end of year numbers is literally is like driving, looking the rear mirror. You are not looking in front, you are just looking what happened before. So that is why I recommend that you should really get them done, because it will help you to make better decisions and to get more opportunity. So the question is, what's the minimum amount of time should a business owner allocate to spend looking at management accounts, KPIs, etc. per week? And I don't mean doing bookkeeping or paying suppliers, so just analyzing and looking at the information.
Yes, well, you can be quite clever about setting it up that you can have these key performance indicators that give you a helicopter view of how what your position is, say. So I would typically say I think you should definitely spend an hour to 2 hours on it. And if you don't have the time, even an hour just to do an overview of those. So say, for instance, your sales, are they up on the previous week? Are they increased from this particular week last year? You can have templates set up that mainstream this so that it's very, it's quite easy and quick to look at it. Another thing would be to look at your operating expenses, say, look at your wages relative to your sales. What percentage of wages is part of your sales? Do you need to reduce that? Or if it's higher, why, etc. So it's all these key performance indicators, and if you set those up specifically, you could pick about 3 or 4, like say your sales, your gross margin, your wages percentage to sales, your break-even point. You can review them on a weekly basis, and as I said, like we have target sheets and profit and loss sheets that you can maintain so that you can look at this very, very easily and quickly.
That's brilliant. So I'm conscious of the time, and so I have my last question.
Mm-hmm.
So what are the 3 simple, and for the people in the call, so you can actually put your questions on the chat or in the Q&A if you have more questions. So what are the 3 simple steps business owners can take today to improve their finances?
Okay,
Quick
so
and easy.
okay, so number 1, I would definitely put target sheets in place, say for your sales and your costs. Number 2, use a good accounting software or cloud accounting software. And number 3, know your cash flow. And I would say, like going back to point number 1, the target sheets, I would recommend do up target sheets for your sales and your costs. These are very easy templates. You can calculate your break-even point from that as well. And then you can also prepare budgets from that to really steer your business. For number 2, with the good cloud accounting software, if you have this implemented, you can track your expenses. You can set up bank feeds between your cloud accounting with your bank. So you're going to see your transactions on a daily basis from the bank as you open your software and look at it. You can issue customer invoices from that. You can set up automated payments and link to electronic facilities like, say, go cardless. You can automate debtors statements if you don't want to chase payment yourself. And they're actually very affordable as well. And they give you excellent visibility on your accounts. Plus, you can have your accountant link in with them as well, so they can also work on the system, and your bookkeeper. And then thirdly, I would say know your cash flow. So as I was saying, cash flow is king. Know what the money's coming in and going out. Be prepared for those dips that you have, cash flow cover there for those high costs that may come in, and that you're paying everything as it needs to be paid, and that you're also most importantly as well being paid yourself. So yeah.
Wow, that's very good. So three quick things that you can do: target sheets, accounting software and cloud accounting software, and know your cash flow. So before I just wrap up, so today we cover a lot of things. So some of the key takeaways that I wrote down. First thing, know your numbers. Second, sales is for vanity, profit for sanity. 3, cash flow is the lifeblood of your business. And then there is bank balance. So consistently know your balance, so that you know that the money that you have in the bank, it is supporting the strategies that you had for your business. So before we wrap up, there is another question. Software, which software is recommended for startups?
Yeah, there's a number of softwares. The software that we use that I would highly recommend, it's called Xero Cloud Accounting Software, and it's Xero is how it's spelt. And they have different suites. So they have a starter pack, and then it's really good. So, say for startups, as your business is growing and you are developing, and say in year 2 or year 3, you can upgrade then to the standard Xero. And there's a premium version as well. So the software, adjusts relative to the growth of your business. So I would recommend that.
Brilliant. Thank you. So thank you, Angela, very much for really, really informative. I have a lot of notes. So tell me where people can reach out to you if they want to connect with you.
Absolutely. So I can put the details in the chat. So I'm on LinkedIn under Angela O'Leary, and you can reach me by email as well, which is angela@agassociates.ie. And pick up the phone. Feel free to call us as well. So yeah, we'd be delighted to hear from you.
Thank you very much, Angela. Thank you very much for everyone who joined. Our next session, it will be on March the 26th, a small business, big targets, protect yourself. So it's going to be all about safeguard your business from cybersecurity threats and also data breaches. Thank you very much, everyone, and I'll see you